Hello, guys. Welcome to your market report for this Thursday, the 3rd of May, 2018. And listen, I got a bit of a head cold today. But anyway, I'm going to get right into the market report. So we're going to start the charts right here. And the first thing we're going to look at is the silver price. So we're going to have to haul the chart in a little bit to take a good look at it. This is the third day of it sliding back upwards again. So we've had a little move up in price. Thing is it's just below 1650. It's like 1640, 1648 or something like that. They haven't got the price in there right now, but it's right around there. But as you can see, as 2 days ago was this blue line down here, and it went down as low as almost 1605, something like that. Now it's back up. It's close to 1650, and it's more in a more normal range. This is its lower range, around 1650 is its lower range. 1720s its higher range that it's been running at for the last little while. So this is good. Silver's back into it. Silver's actually showing a lot of strength, being as the dollars went up this much, and being as what the Fed's doing and everything else, you know. Silver's actually showing quite a bit of strength. Now let's take a look at cryptocurrency. And we're at Bitstamp right now. It's 93.50. Excuse me, I got something in my eye. This cold is making my eyes water and stuff today. Something awful. Anyway, 93.50 on cryptocurrency, and it's been moving up. It could actually broach 10,000 over the next little while, because as the markets are falling, people are looking for investments with yield, and cryptocurrency seems to be one of the better choices. I say seems to be one of the better choices for yield. They'll do anything for yield right now. Cryptocurrency market capitalizations. We're looking at market cap of $444 billion, and Bitcoin dominance is at 35.7. Bitcoin dominance has been falling. It's going to continue to fall. I think it's going to bottom out at around 10% at when it finally gets to where it's going. But that's quite a little while from now. And by that time, Bitcoin will be over $100,000. So that tells you by me saying that Bitcoin is going to be over $100,000 a coin, and Bitcoin dominance is going to be less than 10%. That should give you an indicator of how high I think that these altcoins are going to go. Bitcoin is over $100,000 each, and it's less than 10% dominant over the altcoins. Does that tell you what a great investment these altcoins are going to be in the future? What I just said there, and they are going to be. But I think in the interim, before we get into the future, where these coins are going to be such a good investment, I think we're going to go through a harsh period. And so you're going to be able to get in awful cheap, I think, during this harsh period, because deflation is coming. Deflation is coming. I think this afternoon I'm going to do a little story on deflation. Deflation is not as silly as people think, but it's only going to last a very short period in time. Deflation. And then we're going to go through a period of inflation. Anyway, let's take a look here at, actually, it's not a period of inflation. It's going to be hyperinflation, worse than regular inflation even, after the deflation ends. But let's take a look here at the market real quick. It's down 156 points today so far, and it's 23,768. Now, the market's going to bounce off of support. Its support line. Why I say the market's going to bounce when it hits 23,000 is because that's support. It's going to hit support, and rather strong support around 23,000, and it's going to bounce off of that support back up to probably 23,500 or something like that. In the short term, that's what's going to do in the short term. Now we see resistance here. The resistance line is around right there on that point right there. There's your resistance right there, 25,709. That's right around where the resistance is for the market. So It meets resistance right around that point, and it's going to hit support when it gets down to 23,000. And so it should bounce off of support too. So what we're going to have is we're going to have a market that's bouncing between resistance and support here for the next little while. Just from the short term. Now, okay, so what we got is we got the Fed raised the rate in March, April, May, and June. January, February, March, April, May, and June. So the end of June, they're going to raise it to $40 billion a month, right? And so this is going to have an effect of starting to get those bond yields start to rise again. Now, like I said before, the bond yields got to get up to 3.25 before I think we're really going to see this market roll over and fall. We're going to have to get that bond yield up there. And I don't think the bond yield's going to hit that high until they get this thing higher. It's a cumulative effect what the Fed's doing. The Fed, everything has to do with what the Fed's doing. This market. If the Fed were to turn around tomorrow morning and say, okay, we've decided we're not going to raise interest rates anymore. We're going to go back to a new round of quantitative easing, and we're going to stop our tightening program, quantitative tightening. We're going to stop it altogether. These markets would rally, around that news. The reason why the markets are falling off is because the Fed is tightening. We've seen the markets rally up until the Fed started really getting serious about their tightening program. And what's happened is we're seeing the markets fall off because the Fed is tightening. These markets are so controlled and so contrived now. It all revolves around what the Fed's doing. Everybody sits around waiting for the Fed meeting, and they sit around waiting for the Fed's going to come out and tell what the Fed's going to do, and they look for clues in the things that the Fed says to determine what the market's going to do. And it does. It determines directly what this market's going to do. And the Fed is not going to quit now at this point. I really don't think the chances of them quitting is very slim. They're going to keep on with this program that they got going until they break this market. Then when they break this market, then they're going to be forced into quitting and going back, like I say, and re-stimulating everything. Problem is they know. This is why they're trapped. They know that when they go back to stimulating, they're going to blow up the dollar. It's going to be the end of the dollar. Man, I got something in my eye. It's driving me crazy, but I'm going to continue through with this until I get this market report done. My eyes watering, and it's got something in it, a little piece of dust or something. I don't know. I'll go get it out when I get done the market report. I'll just keep it shut until then. Bonds and rates. What we're looking at is 2.948 on the U.S. 10-year. Well, right now 2.95. It just jumped. This is hit a little spot where it's moved down a little bit today. Actually, it's hit a little spot where we're finding buyers in there. Evidently, if it's not the Fed, there must be other buyers. Maybe it's them chasing yield. I'm just not exactly sure. Maybe they moved out 200 points out of the stock market today, and maybe they're moving into bonds and they're chasing yields. I'm just not exactly sure, but I do know when the Fed starts to pull out, they raise it from 30 billion to 40 billion. That cumulative effect should start raising the bond yields up again. They should start going up again. And so when will that be? Well, it's January, February, March. And then April, May, and June. So it's the 1st of July. So early in July, we should start seeing the bond yield starting to go up again, heading toward 3.25. And honest to goodness, they're so good at kicking things down the road. It seems like maybe this big market crash might not really happen, and might not really happen until sometime this fall. There is that entire possibility. But believe me, she's coming. The market crash is coming unless the Fed, because it cannot possibly get past the Fed every month pulling $50 billion out of the system. That just can't happen. And if we wait until this fall sometime, let's say January, February, March, April, May, June, July, August, September, I guess around the 1st of September, they will be up to $50 billion a month. They're going to be drawing $50 billion a month of liquidity out of the system. That's the same liquidity that they pump back in to get these markets up. So, I mean, you know what's going to happen. If you take and you fill a balloon up full of air, and then if you let the same air out you put in the balloon's going to deflate. And that's what's happening with the economy. They're letting the same money out that they put in. They put it in on one end, and now they're taking it out on the other. You know the economy's going to deflate. The only thing that inflated it in the first place was the money that they put in. $4.5 trillion. Trillion dollars. And now they're going to haul that money back out again? What do you think's going to happen? It's a no-brainer. At a certain point, though, when the system collapses, it's going to create such a toxic effect that the Fed is going to have to relent on this, and then they're going to have to come back with bigger stimulus. But that's what they're waiting for, because then once they get that, once the system does collapse into an event that starts to destroy the system, then they can come in and they can enrich their banker friends. And they can be the heroes at the same time. It's a win-win for them, you know. So anyway, let's take a look at the U.S. dollar index, 92.52. I'm expecting it to go down to around 91. I'm expecting it to back off a little bit. And when the dollar backs off, it's very, very likely, I'm not going to say for sure, but it's very, very likely that gold and silver could go back up a little bit. Silver could go back up into its range of around 1720. Once the dollar backs off a little bit from this charge it's been on lately. And the only thing that's been supporting this charge is I think a little bit of short selling and stuff. They're covering their short positions and stuff, and I think once that's over, and I think it'll be over pretty soon, I think we're going to see it back off to 91 on the dollar. And when it backs out, but that's only temporary. I think it's going to stay in around 89, 90, 91, in around that area until the market really starts to fall. And then when the market really starts to fall big, probably this fall, to tell you the truth, that's what it's looking like now. When the market really starts to turn over this fall, then we're going to see strength in the dollar. And I'm expecting the dollar to go all the way up to 96 before it dies. What I mean dies is when the Fed relents and they come back in and they turn monetary policy around, the dollar's going to start to die, and it's going to drop from 96 to 95, 94, 93, 92, 91, into the 80s, into the 70s, and it's actually going to drop below 70. And when it drops below 70, when it goes to 69, that's when the dollar's really going to start to die fast then. That's when we're going to go into our hyperinflation. That's the marking point for the start of the hyperinflation, is when the dollar breaks below 70 on the U.S. dollar index. So listen, thank you guys for listening. Like and subscribe, and we'll catch you in the next market report coming right up very soon. Bye-bye for now.